as far as unemployment goes, because I just saw this chart out of Bank of America that shows that higher income earners are actually filing for unemployment at a faster rate than the lower income tiers. What are your thoughts on that? Because we know that's a key point for the Fed. And as AI takes a hold, that may be a case even going further along.
This is exactly right. The disruption is going to occur at the higher end jobs, and people are thinking it's the lower end, and they are wrong. It's the higher end. Now, obviously, there's a lot of kinks that have to be worked out. But, you know, you're talking about kinks that can be resolved probably within 36 months. So 3 years, and we could potentially have a lot of people that are highly educated and highly paid no longer really contributing. Obviously, it's going to take a while to build out all of that, Glenn, and to really see, that total disruption. But, what we do track on a frequent basis is the average hours of production. And we track that and we overlay that with the 4-week leading initial jobless claims. And what we're seeing now is that weekly average production numbers, because wage inflation did create higher wages per hour, now the hours of production are getting cut because demand is cut, the economy is softening. And as we see the hours of the lower end workers coming down, we start to see the rolling unemployment initial jobs claims going up. So I'm starting to see a labor change, just like you picked up with Bank of America. And that's going to be hard for Powell because that's been the one stalwart that's allowed him to do these 11 rate hikes.
Yeah, and slowly but surely that unemployment has started to just tick up a little bit, right? But I do want to stay on the Fed because all year you said that the market has it wrong, right? And that the Fed will likely go higher for longer. The majority of market expectations early on this year were for cuts in Q3, Q4 of this year, right? Now everyone's jumping out to 2024, going Q2, Q3. Has your view changed at all as we go into that September decision looming?
Yeah, I think that we are at the precipice now of liquidity crisis. We have two real factors, Glenn, that are happening at the same time. We have the M2 money supply, which year over year through July had a 4.8% annual contraction. That is a recession, depression level contraction. We haven't seen that really besides the global financial crisis. We haven't seen that since 1929. That's the year. 1929, that should tell you something, right? And so you've got the M2 money contraction, and along with that liquidity drying up, you have banks tightening credit. And it's the same pattern. We see the same pattern of tightening credit in 2008, 2009. We saw it in the dot-com crash. We saw it in the 90s. We saw it in the 80s. Every single recession post 1980, we have seen this exact thing happen where the lending requirements just completely tighten. And that's going to hurt commercial lending. You're not going to be able to refinance when you need to. And obviously, we know that the mortgage rates are much higher. And the only reason that we haven't seen a complete crash on the retail side of the retail real estate space is because there's a supply problem. We don't have enough houses. We don't have enough apartments. Otherwise, we'd have big problems on the price of those things now with higher interest rates. So as far as the Fed, I did not see them pivoting at all this year. There's no chance. You don't understand. There's no ability. We literally, and let me just give this perspective to you, because people don't understand this. In fourth quarter of 2019, we recapitalized our investment banks to the tune of $11 trillion. That was just reported by statutory regulation right when it had to be in 2022. Nobody even knew that happened until last year. So then coronavirus happened. On top of that 11 trillion, we then printed another 20 trillion just to get the United States through coronavirus. And that's the total number over all of the programs over all the time. And so the Fed's balance sheet is over $8 trillion. They're in a net negative interest rate situation. They're paying out more in the reverse repos than they're actually earning on their $8 trillion because all of that was issued in coronavirus years with absolutely, next to zero cost of Fed funds rate. So what you're talking about here is a net negative. They've lost the equivalent of almost $1 trillion on their balance sheet. This is the Fed, and they're supposed to be running off $100 billion a month on QT. So where's the cut going to come? Where's their stimulus going to come? We can't stimulate ourselves out of this problem. And this is our own fault. This is America's fault. It's squarely on our shoulders. We thought we could just keep printing. We started to believe that money grows on trees because it's made of paper, and it's completely collapsing. This is we're at a precipice, and the Fed has no ability to re-stimulate at this time.
Yeah, John, I see you nodding your head there. You in agreement with her there on that?
Sadly, I am, because I wish I saw What I thought back in the second quarter, Rebecca, was early second quarter. I thought the Fed was nearly out of bullets as far as raising interest rates, because of course the largest impact is the federal government, because we're the biggest borrower. I mean, it's not Rebecca, it's not John and Pete and Greg. It is the federal government that is such a big borrower. And so by jacking up rates, they're hurting themselves, hurting all of us. So I thought that they would have topped out on those interest rate hikes earlier than where they are now. Obviously, they'll talk tough into Jackson Hole. They'll come out of Jackson Hole still talking, and not until the September Fed meeting are they going to move, unless, of course, there was an emergency, which I don't think either of us see right now. So anyway, I had hoped, Rebecca, that we would see fourth quarter cuts this year. And now more and more, it seems that, like I say, you are correct. I'm not unhappy that you're correct. I'm unhappy because that's going to hurt us more. It's going to drive us, I think, into a recession.
Want more from Market Rebellion? Don't forget to like and subscribe, and learn more about options trading at marketrebellion.com.